In my previous video, I talked about how there's a bit of a difference going on right now in yields, interest rates in the US versus Canada. The US has been running higher since the Fed cut 0.5%, whereas Canada has been kind of kicking and screaming as it gets dragged higher by the US. There's a relationship between US and Canadian yields, or I should say interest rates. Our economies are quite tightly integrated with one another. So as one country's interest rates go higher, it kind of drags the other countries higher as well. Now, they operate kind of like with an elastic band around them. They can move in different directions, but the farther they move away from one another, that force of being pulled back towards the other increases, kind of like an elastic band. And right now, there's quite a large variance between US and Canadian rates. Eventually, the Canadian dollar will react and depreciate, and we're starting to see that already lately. And as the Canadian dollar depreciates, that makes our exports more attractive to foreigners, which then helps our economy strengthen, which then brings Canadian yields back up in line with US yields. Or what could happen is the US economic data starts to come in weaker, and then the US yields come down to catch up with where Canadian yields are. So that's kind of the relationship. And in this chart here, you kind of see this is the difference between Canadian and US yields over time. And you can kind of see the relationship. Very rarely does the difference between the two go beyond like 1.5%. And I think right now we're at about 1.25%. So we're near the extreme. So I don't expect it to go that much farther from here. But time will tell. Take care.